I guess we all knew that they were keen to get back to buying back their stock or increase their dividends, but they came across as resoundingly keen to do so. Do you expect them to get approval? And does the messaging there suggest they're going to go all out and deploy as much capital as they can?
Look, I think what's happened over the last few months is that these banks have just become a lot more optimistic on the outlook heading into 2021. So I think they're seeing a few things. So consumer spending has picked up over the course of the last few months. Loans that were in forbearance or put into forbearance in March are all starting to cure at a better rate, which makes them feel a lot better about the loan reserves they have. Corporate confidence has obviously picked up as a result of the vaccine news, and capital market activity continues to be really, really good. I mean, a number of these banks talked about trading revenues in the fourth quarter, and trading revenues are up 15 to 20% year on year. So I think all of these banks basically are seeing their capital position improve. They all have excess capital today, and I think they are keen to start buying back stock because I think they actually see good value. The question is, will the Fed allow them? At the moment, there's a moratorium in place on share buybacks. We get the results next Friday of the resubmission on the CCAR, so we'll find out if they can buy back stock, I guess, next week. But clearly, there's the appetite to return as much capital as they can at this point where they still see value in their share prices.
I guess we last really heard from them as a group, like you've gathered this past week, Richard, after earnings in October. Were you surprised at their positive economic outlook relative to October?
I think, keep in mind, what's happened since October is you obviously have the news that you will have, hopefully, a successful vaccine, and that will be rolled out across the country. Clearly, the banks are responding to that. And I think, in addition, I think there's a few other things which they're responding to. The first is that they're monitoring very closely things like cash levels from people who have lost their job as a result of the pandemic. Cash levels in checking accounts are actually still up 20% relative to where they were at the start of the year. And they obviously are seeing continued improvements in confidence. But I think also what they're seeing is pipelines around things like M&A and equity capital markets are also building into next year, and that's giving them better visibility around what the revenue outlook looks like as we head into next year.
Richard, a lot of banks in the third quarter put away much less in terms of reserves for loans that would potentially go bad. But then again, the virus and the economy were in a much different place then, and we've seen jobless claims tick up. We're going into winter. We saw New York City close indoor dining, and things are getting worse. And so I'm wondering if you think that if you're in the camp that you believe that there is this massive windfall for these companies just around the bend when the economy improves and they get to release all of this money and pad their profits, or if you're in the camp where you think they're actually going to need all of that money because that many loans are going to go bad and they'll need to start reserving more in the fourth quarter too.
I mean, pretty much every bank or every major bank said, if you look at trends over the course of the fourth quarter so far, in terms of what drives loan loss reserves, almost without exception, every single one has improved. And keep in mind, look, these banks aren't reserving to losses that they expect over a 3-month period. They're reserving to losses that they expect over a 3 to 5 year period. Clearly, if you do get a successful vaccine, and if you get a sharper rebound in economic activity, even if that happens in year 2 or 3, you are going to have to start releasing reserves now. I think a lot of these banks at this point in time, though, I think would rather keep reserves on the conservative level, simply because there's still a lot of unknowns in terms of what could happen. There's still a number of asset classes where the ultimate losses are unclear, like commercial real estate. But it is clear that, obviously, as the economic outlook improves, it's going to be very hard for them to keep the reserves at the levels they are. We are expecting that a number of these banks, maybe not in the fourth quarter, but over the course of the next 6 to 9 months, may have to release reserves, just given the trends that we can currently see.
So if they're reserving against loans that could go bad in 3 to 5 years, when would they be able to make the call whether they need that money? 2023?
No, I think depending on the shape of the economic recovery next year, I suspect it's something that you could start to see happen in the second half of next year. I mean, keep in mind, because of the stimulus and because of the government support that you've seen, even though these banks have reserved to very high levels, incurred losses are actually still very, very low. So I think they're still waiting to see what happens in the second half of next year in terms of actual losses in their book, and then I think they'll take a view as to what the appropriate reserve level is then.
Shepard Smith here. Thanks for watching CNBC on YouTube.